Historically, Chinese investors have been home biased, with around 95% of their equity investments allocated domestically. However, investors across the globe are starting to see the impact of increasing geopolitical tensions, rising inflation, and monetary tightening on asset allocation strategies. For Chinese investors, COVID-related lockdowns, increased volatility of the yuan, and potential economic decoupling added to this uncertainty. Amid this backdrop, Chinese investors have begun to look beyond China's borders for opportunities to diversify their portfolios. The US and China represent two of the largest global economy and equity markets, contributing 14% and 28% respectively to the 5-year global real GDP growth. The US and China weights of the MSCI World Index and MSCI Emerging Markets Index have represented an outsized contribution over the past decade of 69% and 35% as of June 30th, 2022, respectively. Their complementary market exposures represent potential long-term growth and diversification opportunities. Over the past decade, the return correlation between the US and China was about 48%, which was below the average correlation of other markets in the MSCI World Index. Reasons for this include differences in policy objectives and growth drivers, as well as their economies and equity markets being in different stages of development. For example, there are clear differences in sector exposure between the two markets. The MSCI USA Index has a higher exposure to the information technology and healthcare sectors, while the MSCI China and China A indexes are dominated by the consumer discretionary, communication services, industrials, and consumer staples. From a thematic lens, US markets may provide exposure to newly emerged themes that were missing in China, such as blockchain and cybersecurity. In the research for our blog post, we constructed a hypothetical mega-cap USA-China portfolio with a fixed weight allocation to the MSCI China A50 Connect Index and the MSCI USA 50 Index, and simulated scenarios to investigate the potential trade-offs between portfolio risk and other outcomes such as earnings per share growth, carbon intensity, and revenue sources. We found that a portfolio allocating assets between the two markets may reap the benefits of long-term growth and diversification opportunities for investors with varied risk appetites and objectives. In addition, US investors may generate more diversified aggregate portfolio outcomes by partially referencing the MSCI China A50 Connect Index. In summary, using these two pillars of the global equity market may represent an opportunity for Chinese investors to diversify in a volatile investment landscape. To find out more, refer to our latest blog, USA and China Exposures.